go. Did you guys see this news? How many? Tell me. Okay. What the heck is going on with these guys? I found another element of bankruptcy cost here. Another element of bankruptcy cost. You know what has been going on in heavy industry, right? Over the last decade, our heavy industry has been going down, deep down to the red. Okay? Because of the competition coming from China. So what should have been done? Well, you can lose market share to Chinese or whatever emerging country, but you can still be profitable if you try to manage your company to the best of your efficiency. Go to high margin industry or do something smarter. Don't just stay there. But you can see what must have been going on with their management's mind, right? Their mindset is still there in the 1960s. Okay? And then, moreover, some of these heavy industry companies like Daewoo, they have been hiding those losses. 1 trillion won per year for 16 years. Now it's becoming like the 16 trillion won newly disclosed losses. Okay? And then these guys, Hyundai Heavy Industry is just neighboring company, and they are not too much different. They are all together in the same trouble. Right now they are asking for bailout money from the government. Okay, 구제금융. Not 구제금융, but they say in a newly fashioned term. What is that? Quantitative easing? 양적 완화? Quantitative easing, my eyes. Come on. That's not for this kind of bailout purpose. It's not about printing money to save these badly performing guys. Okay? We call it moral hazard, not quantitative easing. What will that, if the central government print out money to save these guys, what will happen to our economy? By and by, every now and then, everybody will try to come to the central bank and say, here, our poor company is going bankrupt. We print out money, more and more and more and more, and we all will suffer hyperinflation, right? Hyperinflation. Of course, this is the era of deflation, but so we need some inflation in the first place, but hyperinflation is something we don't want in any case, right? And then, I told you I identified another element of bankruptcy cost. If you think back about the adjusted present value concept, your company's firm value, it gets back to our trade-off theory of capital structure, right? When you borrow more, there is a benefit, which is interest tax shield, present value of interest tax shield. There is a cost, which is expected bankruptcy cost, right? What was this example of bankruptcy cost? Your lawyers, right? And CPAs, they try to charge you crazy amount of, bankruptcy lawyer expenses. Fees. What else do we have? Your customers fly away. In this example, right? Did you see the news yesterday or the day before that over the last month, their number of shipping orders or ship orders was absolute zero. No order came to them at all. They lost customers, right? The customers are flying away from their business. Okay, trouble time. Okay, your customer flies away. Another cost is what? Your employees start to polish their resume and then look for other alternative job opportunities, right? Why should I waste my time in the company? It's gonna go bankrupt. I'm gonna fly over. I found another element over here. Your top management guys start to do some stupid things in Marine Corps training camp and do some 필승, and then waste their time. They're not thinking about their opportunity cost. Opportunity cost. What? They should not even have time to think about this kind of thing. They should busily chasing after this creditors, right? The bankers, and then beg them, right? Please extend this loan somehow, or go to the customer and say, persuade them. We are not going to go bankrupt, okay? We are heavy industry, famous guys. We will deliver back and we'll come back. Okay, we have to convince them. It's not time for you to go to this camp and then do stupid things. And then talking about the creditors. What were their major creditors? KDB, your dream job. When many of you say, I want to work for KDB, I want to work for Suchuribuneng, which is Kexin Bank, right? Korea Export and Import Bank, okay? Kexin Bank. Well, some of you told me that our 선배님 predecessors who are working in Kexin Bank, they said they're working extremely busy over there. It's not like a 철밥통 thing. Well, if you were not really 철밥통 thing, why did this kind of things happen over here? Okay? This tells us that these guys were not great monitors. They were lazy. They wasted their time together with these guys. Okay? That's why I say don't go to this kind of company. Some of you say, I'm going to go 재수 or 상수 to go to Kexin Bank. That's going to be my dream job. Get some life, come on. Get some life, it's not even good for your whole country. Shame on you if you're working for Kexin Bank. Or KDB, come on. Okay. So, wake up call, please, right? That's that. I'm gonna keep it. Right, so, yeah, bankruptcy cost. And then, firm valuation, okay? We're going to work with free cash flow to firm. And that cash flow comes from the operational side, day-to-day business, operational side. And then that's going to be available to debt holders and equity holders. How do we get the present value of this free cash flow to firm? We have two choices. One is discounting at WACC, the other is discounting at your unlevered cost of capital, which is called APV method. Okay? We're going to talk about it more in detail in a couple of weeks later. Okay? Right now, we will focus on WACC method. Okay? And then, free cash flow to firm, discounted and weighted average cost of capital. This cash flow is the residual cash flow after meeting all operating expenses, taxes, but before debt repayment. Okay, so that it's going to be available to both debt holders and equity holders, right? And it is defined as, in your familiar, bless you, with it, I don't know. Cash flow is defined as after-tax operating income. Notice that this is marginal tax rate, remember? And depreciation added back because your accounting rules said, matching principle, accrual-based accounting said, depreciation is an expense, but you realize it's non-cash expense. Bring it back, and then subtract your capital expenditure, long-term investment, and change in working capital, short-term investment to support your sales. So it's like answering the hypothetical question, like what would this firm's cash flow be if it had no debt or associated payments, or you can get to the unlevered firm value with this one, okay? And even with that debt amount, you can still think about it this way. You don't have to worry about debt holders' part. What is the cash flow purely coming from the operation, okay? And then FCFF does not incorporate any of tax benefits due to interest payment. What we are trying to say is that those FCFF at WACC, okay, is already incorporating all these things: present value of interest, tax shield, or bankruptcy cost. They are just melted into this weighted average cost of capital. You don't have to worry about it. Okay? One shot, you're done. Okay? And then once you get the value of the firm, enterprise value more specifically, once you get the enterprise value, don't forget to add cash. Remember this? Did I? Yeah. So there's card. Okay. What was I trying to do? Yes. Free cash flow at WACC. You're gonna get EV, enterprise value. This guy. Okay. Here's cash. So don't forget to add it so that you'll get to the firm value. Enterprise value, add cash, and then firm value. And then subtract out your debt. There will be one more item to subtract called minority interest, but we're going to talk about it at the end of this class. And then get to equity. Right? Finally get to equity. And this is rather indirect approach. And then be cautious about using the model for firms that have high leverage ratios. For example, high leverage ratio, 대우 heavy industry, 대우 중공업, 대우 해양조선. 대우 해양조선. Do you know their debt to equity ratio right now? About 1,000%. Can you imagine that? 1,000%. Equity is just this kind of companies, right? Troubled companies. You cannot use weighted WACC model, okay? You cannot use WACC model for that troubled companies because you are here and you cannot imagine that you can sustain this kind of 1,000% leverage ratio forever. Sooner or later you have to shrink it down, bring it down. Otherwise, you will be kicked out of the business as a whole. Get out of here, okay? So you will have to assume a decrease in leverage ratio, restructuring your debt somehow, okay? In that case, WACC does not work, but adjusted present value will work for you, okay? Period by period, you'll have to think about interest tax shield and then get the present value of it, okay? Another case is when we do leveraged buyout, okay? LBO is a situation like this. I am a private equity fund manager, private equity, PEF, if you ever heard about it. Or the name like Blackstone or INM in Korean case, right? They're famous guys there. This is what they do. They target a certain company and take over this company, but with the borrowed money. I go to bank and then say, I'm going to take over that company. Once that deal is done, you lend some money to me, a lot of money to me, and then I collateralize the company's assets over the target's assets over there. Okay, so that's the idea of leveraged buyout. Take over this company and take out of the public market, keep it private. LBO. Okay, we're going to go through this example a couple of weeks later. And then LBO situation, the company will have extremely high leverage ratio like this. You cannot sustain this leverage ratio infinite horizon, so you have to schedule, or how do you say? You have to program it so that you will repay those debts and then reduce the leverage ratio to industry average later on. Okay? In that situation, again, you cannot use WACC because WACC is assuming a stable leverage ratio. In that situation, you have to use adjusted present value method. Okay? And then, right? So the WACC approach is easier when the firms are maintaining stable debt to equity proportion. When the company has stable leverage ratio, you have therefore two choices. One is FCFF at WACC, okay? if the leverage ratio is about here. Alternatively, you can use FCFE. Okay, remember the FCFE is net income minus your equity holders' reinvestment, which is 1 minus this A, which is debt over invested capital. Right? Here we were assuming a certain fixed portion of your investment comes from the debt holders, which means, i.e., stable leverage ratio in the future. So when your company has stable leverage ratio, you can go either way, FCFE or FCFF. Okay? And typically people come and ask me, my company for our I-Corp project, okay, do we have to use, is it safe to say that our company will have stable leverage ratio? Okay? Can we use FCFF or FCFE instead of APV? Well, let's look at the leverage ratio of your company. And they say, well, it was hovering around 50%, sometimes 70, sometimes 40, da 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 da. Is it something we say is stable or not? And I say, yeah, it's stable rather. Okay, it's stable. When we say unstable, we are talking about this kind of leverage ratio. Okay, this kind of 1000% or above, and then going down. Right? That's unstable leverage ratio. This one is rather, okay to assume it's stable. My company is changing the debt to equity ratio is changing by 5 percentage points. That's stable. Okay. So use FCFF, whack. All right, fine. And then FCFF versus FCFE is completely fine, indifferent, whichever way you choose. You have a question?
For the LBO, does the leverage go into the company that's trying to target the company, or does the leverage go into the company that's being targeted?
Targeted company, once it is acquired, right? It will be one company. So the borrower will be the acquirer company in the first place, right? It's not the fund itself, but the new company, right? With the promise that you will take over the company, the new company. Right? So Hyundai Motors, right? I threw out one example of FCFF just by doing it myself, right? It's not on the textbook, but I just wanted to go through as a test case or demonstration about how to do FCFF, right? If you have a question? No? Everything all right? Okay. Hyundai Motors, right? Let's do the valuation of this, our good old friend, right? Just to do the DCF, right? We need some pretty good information about, we need to have some good idea about how the management has been doing, okay? That's why I'm trying to show you historical performance of it. Right? Right. And then you have a question there or any concerns? No? Sorry, fine. Right? Right. I was standing in 2011, okay? Standing in 2011, and I was trying to value this company. And then, in order to have some idea about the company's competence or the management's competence, I wanted to focus on two things, okay? Two things. One is ROC and the other is EBIT margin, okay? EBIT margin. ROC, what is that? Return on capital. Return on capital. How is it defined? It is after-tax operating income divided by invested capital. That sounds familiar. Is that invested capital the invested capital that we talked about in FCFE? And then answer is yes, okay? Book value based debt plus equity. Look at last year's balance sheet, and then this thing will be given to you. Okay? And then it tells you an idea about this. Based on the investment coming from debt holders and equity holders, how much after-tax operating income did the company generate? Okay. Investment, after-tax operating income relative to the invested capital. Okay? Perhaps the most important measure of profitability or efficiency of your company. Okay? And then another metric that I wanted to use is EBIT margin, which is operating income divided by sales. Whatever margin always typically says divide by sales, okay? Or revenues. Okay? They are the same thing, revenues. Now, my friend who is really owning manufacturing company, his business is about car wheel business, and then sell it to Hankook Tire or something. Okay, and then that goes into your car's tires, green part. And he said, if you are doing manufacturing business, 10% EBIT margin would be a fantastic measure. It's really extremely difficult to achieve it, 10%. So I have some idea about where the EBIT would be, right? 10%. We're looking at Hyundai Motors, it's not 10% yet, right? You see how difficult it is, right? And then historically, looking at EBIT margin, it has been 1% in the beginning of 90s, and then it has been cyclical, especially was bad in East Asian financial crisis time, and then Lehman Brothers global financial crisis time, but it was jumping to 8% to 9% level in boom time. Okay, so it's been cyclical, not that bad, all right? Right? And then ROC, okay, return on capital, the blue dots over here. It has been hovering around the 25% or 30% range, especially over the last decade, but it was more fluctuating before, okay? Still, we see some cyclicality in ROC, the profitability, okay? This kind of cyclicality will give you some challenge later on when we do the projection into the future, cash flow projection. Okay, let's see how that happens. Now, to have some better idea about this company, I wanted to look back their revenue figures over the last 14 years or something, okay? And then you see it has been almost exponentially growing with some bumps, bing, bing, over here, right? A little bit of cyclicality, but it has been growing well. That's good, right? I want you to look at their operating income, right? Operating income, which is EBIT, and then EBITDA, right? EBITDA. So what is EBITDA? That is EBIT plus depreciation and amortization, right? But before we move on further, right? Does anybody, know why people work with EBITDA so much? What does EBITDA about to capture? What is EBITDA trying to capture? Anybody? So this is your job interview, and your future boss asks you what is EBITDA, and you said the definition EBIT plus depreciation, amortization, and your boss next question is why do we? Right.
Compare the actual commercial cost.
So you in order to compare the companies in different countries, overcoming the different regulations about the depreciation and amortization. Any different answers?
Depreciation and amortization is not actual.
Right.
For
Actual, what do you mean by actual, by the way?
is it just book?
Okay. Okay, just a book value number, or is it accrual based number, should I say? So accounting regulation based number. And then it's not actual. So what do you mean by actual? What is the actual number as a finance guy? Cash, right? Cash is king. So EBITDA is trying to get to the cash value, just a minute. Amount of operating cash, okay? cash flow coming from your operation. Of course, you have this free cash flow to firm, right? But it's complicated to compute these free cash flow to firm. I'm too busy to calculate. Is there any easier way to proxy that? Approximately know about that cash flow from operation. That's EBITDA. Where is it? Yeah, over here. Okay. EBITDA. That's the whole purpose of using EBITDA. Some accounting professors long time ago said, like, I hate EBITDA. We're not going to use EBITDA. Don't you ever talk about EBITDA. 20 years ago, people were like that. But you just cannot help it. When it's convenient, just keep on using it. And some people were like saying this too. There is no such thing as free cash flow because there's no free lunch in the first place in the market. But people keep on using free cash flow anyway. Okay? EBITDA is trying to capture the cash flow coming from operation. So let's look at this in the Hyundai Motors, right? EBIT and EBITDA. You see, it's it has a clear trend of going up. That's good, okay? But with some bump, bing, bing, like this, right? We see some cyclicality over there, depending on the business cycle, right? And if we look at the numbers, right, supporting this graph, it looks like this, right? And then Hyundai Motor Company, here's the information. 2011, Hyundai Motor is exceptionally well received in the US and the EU. The company has been aggressively investing in global production facilities such as Alabama factory in the US. We believe that the historical average reinvestment rate was 190% about of after-tax operating income. Though the company cannot maintain such high level of reinvestment, we believe that the company will maintain above 80% reinvestment rate until year 5. Also, the return on capital of the company has been 25 to 30% range. To be conservative, we assume that the company will maintain 27% ROC. I just chose the number. It could have been 27.5% exact average of it. Okay, it's up to you, but it's something in between. Okay, let's just stay with that in the future. Now, what am I trying to do at this fast growth stage? Right. Once we have the idea about reinvestment rate and then the return on capital, we can immediately think about the growth rate in earnings. Growth rate in earnings. Okay. Later, we are going to talk about it in more detail, but the key idea is this: your earnings growth, okay? In this case, it's EBIT. Your earnings growth comes from two sources: how much you reinvest and how much of return that you generate from that reinvestment. Okay? So multiply these two guys: reinvestment rate and ROC, return on capital. Okay, that will give you a growth rate of earnings, right? Growth rate of earnings. Now, if we change the context into equity-based valuation, FCFE or dividend discount model, there you will have to worry about the growth rate of net income. Okay. If we change the context into net income and equity, these two numbers will switch to equivalent figures. Instead of reinvestment rate, we just have equity reinvestment rate. Instead of ROC, you will have ROE equity. Okay? So reinvestment and return, that gives you an idea about how much it grows. Okay? Whatever you plow back and how much return we generate from that plowback. Okay? That's the idea. Now, that's how we do, how I compute the growth rate in the fast-growing stage. But after year number 5, we assume the company will stabilize its growth in earnings. Okay, partly because the market will be saturated. Okay, and then you cannot grow more than the world's GDP growth rate. okay, in the infinite horizon. Otherwise, you will create your own evil empire, right? So, at the stable stage, the way you do changes over here. First, think about the stable growth rate. Set it as 3%, I did. And then we assume that the ROC of the company will be 15% instead of 27% because it's the industry average ROC, and then the company will follow the industry average at that stable stage. Your competition will toughen so that your return will be shrunk down. That's the idea. Okay. And these two numbers will give you the reinvestment rate. You can figure it out. Why? Because you can use this relationship and then you see this one over here. 3% growth rate and 15% ROC, right? Then you see this equation and then you know that there is only one unknown, which is reinvestment rate, RR. You figure it out by solving this equation, which is 20%. So that's how we compute the, settle down the growth rate and reinvestment rate in the stable stage. In high growth stage, we were doing this way. Reinvestment rate, ROC, multiply those two things and then get to the growth rate. Okay? Then the stable stage, a lot of people make mistake. You have to start with the growth rate and then divide it by your ROC to figure out the reinvestment rate. Procedure is a little bit tricky, but don't miss it. Now, that's the box part information. The second part is the normalizing earnings part. As a cyclical company, Hyundai Motors' EBIT margin has been volatile. Since global economic outlook is still gloomy with the sovereign debt crisis, EU and US, we assume that EU EBIT margin of this company to be the same as historical average. Okay, what are we trying to get at here? Well, if we try to plot the EBIT margin of your company, okay, it could be your iCore company's EBIT margin. Okay, I don't know which company it will be, but let's say, looking back in history, you are standing at 9.0 over here. In future, but if you plot the historical EBIT margin of your company, it may look like this, up and down, swinging back and forth, right? Then what do you do? Your animal spirit or your human nature, okay, it's just deeply rooted in our brain circuit to find some visual patterns. I told you before, right? Systematically, our ancestors who were fast at visual pattern recognition survived. Okay? Oh, those things are tigers, and those things are rabbits, right? So we were fast. And then the same thing pops up in our mind when you look at up and down and up and down. Ah, there must be some pattern over there. And then you try to find out, using your familiar function that you learned in your high school education, which is sine function, cosine function, B, right? You want to, your instinct tells you that this must be sine function somewhere, and then there must be some fixed period related to this business, so that this kind of period will sustain over the future, and then the margin up and down will take place, this margin plunging down will take place exactly 2 years from now, and then 5 years from now, and you try to make a guess like that. That's your natural instinct, basic instinct. And I say what? Stay away from that instinct. Okay? Stay away. Try to stay away. Why is that the case? Why is that the case? Because it's just randomly happening. Okay? Almost by chance it just happens, but your visual recognition, okay, forces you to think about this fixed pattern over there. Okay? There is a random shock, always this kind of positive or negative shocks. We assume it to be happening in random time. Okay? Random time. Not on a fixed period. That's the message here. Okay? So, don't try to impose fixed predicted pattern of up and down, but take the average of it. Look back in history, what's the average of this guy? And let's assume this will happen again. This average will be there, okay? And impose this average profitability, that's it, nothing more, okay? Again, the reason is up and down will happen in random time. You never know when it's going to happen, okay? So our approach is here like this, right? Assume that the EBIT margin of this company to be the same as historical average. So looking back in history, over 14 years, I think. Or is it 17 years? Yeah. 17 years. Average operating margin, you can figure it out by taking the average of this operating margin, which is 4.37%, and assume that it's going to happen just in a stable fashion, right? Don't worry about this cyclicality. Okay? Multiply this margin by last year's revenue, and then assume that this operating income will be your operating income next year. Okay? Notice that we did not impose a growth in revenue specifically here, okay? Because of the cyclicality in your operating income in the first place. I just did not try to grow this thing, okay, in the revenues. I could have assumed some revenue growth in the next year, but what is the use? Because my purpose is to focus on operating income only, not the revenue itself, okay? So work with last year's revenues, impose average operating margin to get to the next year's operating income, projected income, which is 5.98 trillion won. Now the last component is marginal tax rate of 25% in Korea. And then one more thing that I'm going to assume is weighted average cost of capital of 9%. I'm not going to waste time computing this discount rate here. So, what you see in this table is, first of all, year number going into the future. The first year, second year, third year, all the way down to sixth year. Fast growth, so 27%, high ROC of 27% will take place in year number 1 through 5, but in your stable year, right, the ROC will be only 15%. Reinvestment rate will be 80% in your initial 5 years, so the growth rate of your operating income will be 22%. You multiply these two, and then you get this one. Right? And then, in your final stage, you don't know about the reinvestment rate yet, but you have those two information about growth rate and ROC, and then you get to the reinvestment rate of 20%. Now, EBIT of year number 1, this guy came from previous slide. Last year's revenue times the average operating margin over the history, okay? That's gonna be next year's EBIT, perfectly fine. And then grow it at 22% rate, and then 3% rate over here. Subtracting tax and the reinvestment computed, right, based on this after-tax operating income. And then you will finally get to the free cash flow to firm. Now, looking at year number 6, right, you have FCFF year 6, okay? And then you're ready to compute the terminal value, which is this guy divided by 9% minus 3%, okay? 9% minus 3%, you get to this number. And then now you're ready to compute the present value of free cash flow to firm, discounted at 9% rate. So if you do the math, then you'll be able to figure out the value of operating assets or enterprise value of 92.7 trillion Korean won. And then don't stop there, add cash, which is 18 trillion won. And then subtract debt of about 50 trillion won, right? Subtract this guy out. Is that market value of equity? Wait a minute. You realize that this company, our information was based on the consolidated balance sheet, okay? Consolidated. 연결회계 기준 kind of thing. Most complicated and horrible thing in accounting. If you master those things and if it is your second nature, you have to become CPA, okay? Not for me, unfortunately, or fortunately. I think it's fortunate. I think it's fortunate not to be accounting guy, right? Anyway, minority interest, right? If your company, Hyundai Motors, is a consolidated basis one, there must be some subsidiaries, 자회사 of your company incorporated into your consolidated balance sheet. Okay? That means some of it, we're going to talk more in detail about it, but let me throw out right up front the way I understand it. Minority interest. For the subsidiaries, right? If your company is 60% owner of your subsidiary and 40% is owned by Samsung Group, okay? You have to show the asset, 100% of your subsidiary's asset as your asset. Okay? What about the equity side? Well, what about the debt side? The debt side, 100% of the subsidiary has to be your debt. Okay? So asset and debt, 100% of the subsidiary, fine. What about the equity? Shouldn't it be 100% of your subsidiary's equity should be shown as your equity, and the accountants say what? No. At that stage, no. Why? Because 40% of this guy, you don't own it yourself. Okay? So let's single this out and say it as minority interest. And show it as minority interest. The portion that you don't own, okay, but that you do not own in your subsidiary. Okay? Let's treat it just like debt or something or liability. You have to subtract it out. They keep it in a separate item, minority interest. Okay? So you find it, minority interest. Of course, it's going to be market value based one. Okay, we're going to learn about it later. So subtract it. Okay? Then finally you will get to the value of equity. Okay? That's not the end. Don't stop there. Divide by the number of shares outstanding. Right? Finally, you're getting to the value per share, which is 234,001 at that time. Current price, 212,000 at the moment of my valuation. So was the company underpriced or overpriced? Underpriced. So we're recommending a buy, right? And then the box over here shows some reality check. Market value of debt, I just assume the book value of debt to be equal to market value of debt anyway. Market value of equity over here, I should have labeled it as market cap, okay? 시가총액. And this guy is just based on the current price and the number of shares outstanding, if I remember correctly. And then book value of equity is over here. What was I trying to get at? Well, I tried to get to the price to book ratio, something called the price to book ratio. This guy divided by this guy. Right? We're going to learn about PB ratio or PBV, okay, in a couple of weeks later. Okay, so that's one of the relative valuation measure. Anyway, so this is one way of getting to the firm value, and then using FCFF discounted at WACC. Measuring cash flows, it's just a rehashing of what we did so far. FCFF, FCFE, and then dividend discount model, or DDM model, DCF model, discounted cash flow. Okay. Steps in cash flow estimation. We have to estimate the current earnings of the company. If looking at cash flows to equity, looking at earnings after interest expenses, i.e. net income. If looking at cash flows to the firm, look at the operating incomes after taxes. Consider how much the firm invested to create future growth. If the investment is not expensed, it will be categorized as capital expenditures. To the extent that the depreciation provides cash flows, it will cover some of these expenditures. Increasing working capital needs are also investment for future growth. That's quite self-explanatory. And what we are going to do in the next chapter is like this, okay? We are going to adjust some of the accounting items, okay, for our purpose of cash flow projection, okay? Cash flow projection. And then for that part, we need some understanding about how to update our earnings. And then we are going to talk about how to reallocate those items, right? Typically, operating leases and R&D expenses, those will be capitalized somehow. I promise you, this is going to be the hardest part of the whole semester. Okay? Most difficult part of the semester, people get awful points off. Hamada equation, and then this guy. Okay? And then one-time charges, how do we take care of those things? And when we find some accounting malfeasance, which is cosmetic accounting, or 분식회계, right? Negative abnormal earnings, how do we take care of these things? Earnings to cash flows, we have to worry about some tax loss carry forward situation, and then reinvestment needs, how do we take care of those things? We're going to talk about it. One thing up front right now that we're going to talk about is how to update our earnings. Okay? How to update our earnings. The idea is this. Looking at our situation. Alright. Thinking about your own term project. Okay? Term project. You're going to be given one company to value. And then today is May 2nd, right? My daughter's birthday. And then, thank you. And then you're assigned for one company. But the thing is, typically, most of the time, the company's fiscal year ends on December 31st, right? So if you are trying to value based on yearly figures only, there's a time lag of about 5 months to 4 months, right? Already here. So the information may not be precise, right? The information may not be precise. So, can we update this thing? And the answer is yes, partly yes. Not to the perfect, but as long as you have quarterly reports, right? Quarterly reports, and that finished before your date of valuation, use that thing, okay? Update it. For example, if I'm doing an evaluation right now, as of May 2nd, I would go to first quarter earnings report. Okay, first quarter earnings report of this year, 2016. And there, especially the income statement items, which is the flow concept items, right? Those things, well, it shows you last year's first quarter revenues all the way down to net income, as well as this year's revenue all the way down to net income. Okay? Income statement items and cash flow statement items. Right? You see this one, and then you have to use it. Well, start with your last year's fiscal year figure, right? Last year's one, and then subtract last year's first quarter figure, so that you'll have 9 months figure over here, and then add this year's first quarter figure, so it will give you a trailing 12 months figure. Okay, see how it works? So in this example over here, I was assuming a third quarter situation. Okay, third quarter situation. If you are valuing in November or December, what should you do? Well, start with last year's revenue. Okay, 10K is annual figure. 10Q is annual figure. 10Q is quarterly figure. Okay, So start with annual figure, subtract the quarterly figure of that fiscal year, this guy. Okay? Subtract it, and then add this year's quarterly figure. Okay? You just cross it out 3 as just one quarter. Okay? That's perfectly legitimate. So that's how we come up with trailing 12 months number. Trailing 12 months number, especially for your income statement items, flow concept items. What about the stock concept items? Stock, flow versus stock, your snapshot figure. Okay, snapshot figure like assets, liabilities, equities, debt, those things. You don't need 12 months trailing figure. All you need is just most recent quarter ends figure. Okay, because this is just a snapshot. Okay, 12 months and then a snapshot. You only need this figure, right? So that's the idea I'm trying to get at. Correcting accounting earnings, right? We're going to talk about this thing in the next class or Wednesday. Okay? So you are free from now. Okay? And then see you on Wednesday, unless you have some questions. Any questions? Right. So see you.